What if I told you that you could turn $10,000 into $100,000 in just 5 years without getting lucky, without gambling, and without needing some insider Wall Street secret? Most people think growing wealth like this requires either a six-figure salary or some kind of miracle. But here's the truth. It doesn't. There's a mathematical formula that anyone can follow. And by the end of this video, you're going to know exactly how to do it. So stick with me, because what I'm about to show you could completely change your financial future. I'm going to walk you through the exact step-by-step strategy to grow $10,000 into $100,000 in 5 years. And no, this isn't some get-rich-quick scheme. This is a proven, realistic plan that combines smart investing, compound growth, and a few strategic moves that most people completely ignore. By the end of this video, you'll understand the three core pillars of this strategy, the specific accounts you need to open, the exact percentages you should be allocating, and the biggest mistakes that will destroy your progress if you're not careful. This is the roadmap. Let's get started. So first, let's talk about the math. Turning 10,000 into 100,000 in 5 years means you need to grow your money by 900%. That sounds insane, right? But here's where most people get it wrong. You're not trying to do this with your initial $10,000 alone. You're combining two things, investment returns and additional contributions. Here's the reality. If you just invested $10,000 and let it sit, you'd need an average annual return of about 58% to hit $100,000 in 5 years. And unless you're some kind of trading genius or incredibly lucky, that's just not happening consistently. The stock market averages around 10% per year historically, so relying purely on returns won't get you there. That's why the real secret is this. You need to add more money over time. This is called dollar cost averaging, and it's one of the most powerful wealth building strategies that exists. Let me break down the numbers for you. If you start with $10,000 and you contribute an additional $1,000 every single month for 5 years, and you earn an average return of 12% per year, do you know where you end up? Right around $100,000. That's the formula. Initial investment plus consistent contributions plus compound growth equals massive results. Now, I know what you're thinking. 12% per year? Is that realistic? Actually, yes. The S&P 500 has averaged about 10% annually over the long term. And if you're strategic with your investments, focusing on growth stocks, index funds, and maybe a small portion in higher risk opportunities, 12% is absolutely achievable. In fact, during strong market years, you could see 15 to 20%, but we're being conservative here. The key takeaway is this. This goal is not about luck. It's about discipline, consistency, and understanding how compound interest works in your favor. Most people never hit their financial goals because they don't commit to the monthly contributions. They invest once and hope for magic. That's not how wealth is built. All right, now let's talk about where you're actually putting this money. Because it's not just about saving $10,000 and throwing it into a random brokerage account. You need a strategy. You need the right accounts and the right asset allocation. Here's what I recommend, and this is the exact framework that I follow. First, open a Roth IRA. This is non-negotiable. A Roth IRA allows your investments to grow completely tax-free. You contribute money that's already been taxed, and when you withdraw it in retirement, you pay zero taxes on the gains. For 2026, you can contribute up to $7,000 per year if you're under 50. So right off the bat, you're maxing this out with your initial $10,000 and your monthly contribution. Inside your Roth IRA, you're going to focus on index funds and ETFs. I'm talking about funds like VOO, which tracks the S&P 500, or VTI, which gives you exposure to the entire U.S. stock market. These are low-cost, diversified, and historically proven to deliver solid returns. You're not trying to pick individual stocks and gamble. You're building a foundation. Now, here's where it gets interesting. You're also going to allocate a portion of your portfolio to growth-focused investments. Think about sectors like technology, healthcare, and clean energy. These are areas that have massive potential over the next 5 years. You could look at funds like QQQ, which focuses on the NASDAQ and tech-heavy companies, or ARK Innovation ETF, if you want more aggressive growth exposure. Let me give you a real example. If you had invested $10,000 in QQQ 5 years ago and contributed $1,000 monthly, you'd be sitting on well over $100,000 today, even with the market volatility we've seen. That's the power of staying consistent in high-growth areas. But here's the critical part. You need to diversify. Don't put everything into one fund or one sector. I recommend a 70-30 split. 70% of your money goes into stable, broad market index funds like VOO or VTI. 30% goes into higher growth opportunities like QQQ or sector-specific ETFs. This balance protects you from major losses while still giving you the upside you need to hit that $100,000 target. Remember, we're not gambling here. We're strategically positioning ourselves for growth while managing risk. And one more thing, automate everything. Set up automatic transfers from your checking account to your investment account every single month. The moment you get paid, that $1,000 should be moving into your investments before you even think about spending it. Automation removes emotion from the equation, and emotion is what kills most people's financial plans. Now, let's address the elephant in the room. $1,000 a month is $12,000 a year. Not everyone has that kind of extra cash lying around. So how do you actually make this work? This is where most finance videos stop. But I'm going to go deeper because this is the real reason people fail. You can have the perfect investment strategy, but if you can't fund it, it doesn't matter. You need to increase your income or cut your expenses, ideally both. Let's start with income. The fastest way to boost your contributions is to increase how much money you're bringing in every month. And no, I'm not talking about working yourself to death with 3 jobs. I'm talking about strategic income moves. First option, side hustles. And I don't mean driving for Uber if you don't want to. I'm talking about leveraging skills you already have. Can you freelance, write, design, code, consult? There are people making an extra $1,000 to $2,000 per month freelancing on platforms like Upwork, Fiverr, or even just reaching out to local businesses. Here's a real-world example. I know someone who started offering social media management services to small businesses in their area. They had 0 experience, but learned the basics on YouTube. Within 3 months, they were making $1,500 a month on the side. That's $18,000 a year. That alone would overfund this entire strategy. Second option, ask for a raise or switch jobs. This is the one people avoid because it's uncomfortable, but it's also the highest leverage move you can make. If you're good at what you do and you haven't gotten a raise in over a year, it's time to have that conversation. Research shows that people who negotiate their salary earn significantly more over their lifetime. And if your current job won't pay you what you're worth, start looking. The job market has been strong, and companies are competing for talent. A 10 to 20% pay increase from a job switch could give you an extra $500 to $1,000 per month. That's literally the exact amount you need to fund this strategy. Third option, sell stuff you don't need. I'm serious. Most people have thousands of dollars worth of things sitting in their closets, garages, and storage units. Old electronics, clothes, furniture, collectibles, listed on Facebook Marketplace, eBay, or Poshmark. You could easily generate $1,000 to $3,000 in the first month just by decluttering. Now let's talk expenses. You don't need to live like a monk, but you do need to be intentional. Track your spending for 1 month. I guarantee you'll find at least $200 to $300 in expenses that you didn't even realize you were wasting. Subscriptions you forgot about, eating out too often, impulse purchases. Cut the waste. Redirect that money into your investments. This isn't about deprivation, it's about prioritization. Would you rather spend $300 a month on things you'll forget about, or would you rather turn that into $30,000 in 5 years? The choice is obvious when you frame it that way. All right, we've covered the strategy, we've covered the accounts, we've covered how to fund it. Now let's talk about the mistakes that will absolutely destroy your progress if you're not careful. Mistake number one, stopping your contributions when the market drops. This is the biggest killer of wealth building plans. The market will drop. It always does. There will be months where your portfolio is down 5, 10, even 20%. And when that happens, your brain is going to scream at you to stop investing. Don't listen. When the market drops, that's actually when you should be most excited to invest because you're buying assets at a discount. Think about it like this. If your favorite store had a 50% off sale, would you stop shopping there? No, you'd buy more. The same logic applies to investing. Here's a real example. During the COVID crash in March 2020, the market dropped over 30%. People who panicked and sold locked in their losses. People who kept investing or even increased their contributions saw massive gains as the market recovered. Some of the best investors I know made their biggest returns during that period. Mistake number two, trying to time the market. You're going to see headlines, market crash coming, recession fears, is it time to sell? Ignore all of it. Nobody, and I mean nobody, can consistently predict market movements. Not professional investors, not hedge fund managers, not your friend who got lucky on one trade. Your job is simple. Invest consistently every month, no matter what the market is doing. That's it. Dollar cost averaging smooths out volatility and ensures you're buying at different price points. Some months you'll buy high, some months you'll buy low. Over 5 years, it all averages out, and you win. Mistake number four, getting distracted by shiny objects, crypto, meme stocks, your coworker's hot stock tip. These are all distractions. Yes, some people get lucky with these, but for every person who made money on Dogecoin, there are 100 who lost everything. Stick to the plan. Index funds, growth ETFs, consistent contributions. Boring wins. Boring builds wealth. The flashy stuff makes for good stories, but it rarely creates lasting financial success. Mistake number four, not rebalancing your portfolio. Over time, your asset allocation will shift. If your growth stocks do really well, they might end up being 50% of your portfolio instead of 30%. That increases your risk. Once or twice a year, check your allocation and rebalance back to your target percentages. This keeps your risk in check and forces you to sell high and buy low, which is exactly what you want. Most brokerage platforms make this easy. Some even do it automatically. Here's the thing that most people don't understand about building wealth. It's not exciting. It's not fast. It's not glamorous. The first year, you're going to look at your account and see maybe $15,000 to $20,000. You're going to think this is taking forever. But here's where the magic happens. Compound growth is exponential, not linear. In year one, you might grow your portfolio by $2,000. In year two, maybe $4,000. By year three, you're seeing $6,000 to $8,000 gain. And in years 4 and 5, the growth accelerates dramatically because you're earning returns not just on your contributions, but on all the previous gains. Let me show you what this looks like in practice. In year one, with your initial $10,000 and monthly contributions of $1,000 plus a 12% return, you'd end up with around $23,000. Not bad, but not life-changing yet. Year two, you'd be at around $38,000. Year three, around $56,000. Year four, you'd cross $75,000. And in year five, you hit that $100,000 mark. Notice how the growth accelerates? The jump from year 4 to year 5 is $25,000. That's more than your entire first year balance. That's compound interest working in your favor. This is why patience is everything. Most people quit in year 1 or 2 because they don't see massive results yet. But the people who stick with it, who trust the process, who keep contributing even when it feels slow, those are the people who build real wealth. And here's the best part. Once you hit 100,000, the momentum keeps building. 100,000 can become 200,000 much faster than 10,000 became 100,000. Wealth builds on itself. Think about this for a second. If you keep following this exact same strategy after you hit 100,000, you could be at 300,000 in another 5 years, then 500,000, then a million. This is how ordinary people become millionaires, not through lottery tickets or lucky breaks, but through consistent, disciplined investing over time. So let's wrap this up. Turning $10,000 into $100,000 in 5 years is absolutely possible, but it requires 3 things: a clear strategy, consistent contributions, and the discipline to stick with it even when it's hard. Start with $10,000. Invest in a Roth IRA. Focus 70% on broad market index funds and 30% on growth opportunities. Contribute $1,000 every single month. Automate everything. Ignore the noise. Stay patient. Do this, and in 5 years, you'll have $100,000. And more importantly, you'll have built the habits and the knowledge to keep growing that wealth for the rest of your life. If this video helped you, do me a favor. Hit that subscribe button, drop a like, and if you want to see more strategies like this, let me know in the comments what financial goal you're working toward next. Your future self is going to thank you for starting today. Let's build wealth together.